Hello and welcome to the Killik & Co market update. We're focusing mainly on the UK market this week as we've had a few developments here. Firstly, we're looking at offshore wind. The UK has actually done well with wind power in the past, and in fact, over the last 12 months, over 30% of our electricity came from wind power. The UK government is keen to raise this number, but the inflation we've experienced over the last couple of years has dramatically increased the cost of developing new wind farms. And now we're in a situation where many developers who have committed to build wind farms are struggling to do so profitably under the terms of their original contracts. A number of companies in the wind power space have issued profit warnings or reduced their guidance as a result. Here we're comparing the share prices of Ørsted and Siemens Energy, both of which develop wind farms, and then Vestas, which produces the turbines for the farms. You can see the share prices of all three have suffered this year. This is a 5-year chart, but Siemens Energy only listed in 2020, which is why that pink line starts in the middle there. In the UK, the government guarantees a minimum price for the power that will be generated when a wind farm is complete. The government then auctions off sites on which wind farms can be built, and developers will consider this and the price of the power when they're considering how much to bid for a new site. In the past, demand for these sites has been high, but in the latest auction, which took place last week, the government did not receive a single bid. The government has now been criticised for not offering a high enough price for the power that will be generated by these wind farms when they're finished. Here's the UK's spot electricity price over the last 10 years, and you can see that big spike due to the Russia-Ukraine situation. The price is currently just below £90. In the latest offshore wind farm site auction, the developers were offered a guaranteed price of £60. That's far below the current market price. This is a disappointing development for the UK's wind industry, so please do give us a call if you'd like to talk about this in more detail. During the last decade, while interest rates have been very low, many investors have bought into alternative income assets such as commercial property funds and infrastructure funds, examples being International Public Partnerships, London Metric Property and 3i Infrastructure. Now that interest rates for cash accounts and government bonds are higher, many investors have come out of these alternative assets and moved back into cash or government bonds, and this has had a severely negative impact on the shares of these alternative assets, as you can see on this 5-year chart. Another example of an alternative income asset is an investment trust that buys music rights and then pays the royalties to investors in the form of an income stream. One of these such investment trusts is Hipgnosis, which listed in 2018. You can see the shares fell quite heavily in 2022 as interest rates were rising, but this week there's been a rise in the share price for two reasons. The first is that a similar fund called Roundhill Music Royalties was bid for at a significant premium to its share price, and the news of that has boosted the whole sector. Secondly, Hipgnosis has just announced a deal to sell 20% of its music catalogue, and it will use the proceeds to pay off a bit of debt and then to buy back some of its shares, which it thinks are too cheap. It's been a very difficult year for alternative income assets, so it's a pleasant surprise to have some good news for a change. And finally, we've had the latest GDP figures for the UK showing that the economy shrank by 0.5% in July. The poor performance has been blamed on the strikes and the bad weather. Here's a chart showing the size of the UK economy relative to 2019 levels. It's just about back to its pre-COVID level, but as you can see, the growth since late 2021 has been very limited indeed. The Bank of England, therefore, is in a very difficult position. It wants to keep interest rates high to bring inflation down, but high interest rates will limit economic growth. Moving on to have a look at next week, it's again looking very quiet on our calendar and we are not expecting results out from any of our covered companies. That's it from us. Have a great weekend and we look forward to seeing you next Friday.